The problem is, Brandon, that our spending is $6.9 trillion. So that right there, it's just we're taking in 4.9 trillion and we're spending 6.9. So we have a $2 trillion deficit, which means that every single year that it stays at that level, we're adding $2 trillion to our debt. And you can go back and look at it, and our debt has been growing by multiple trillions of dollars over the last number of years. But the reality is that the big issue around this is that now, why is it a debt spiral? Things like Social Security, Medicare, Medicaid, and other programs. But that's about $4.1 trillion. Our defense budget is $950 billion. Okay, so right there, that's over $5 trillion. We're already over budget. So when they go and tax those dollars, they pay down debt from before, past debt, that with dollars that are worth less. So it's a trick. That's great. You have a problem. So what's the solution? What do you propose? Well, you've got three basic solutions.
James Lavish begins by addressing a critical issue: the expansion of the money supply, which has been growing at an average rate of 7.1% annually since 1971. This continuous increase in the money supply is the essence of inflationary pressure. The logic is straightforward. With more dollars in circulation chasing the same or fewer goods and services, the value of each dollar decreases. This leads to higher prices as more money competes for the same quantity of goods. Imagine a scenario where the number of apples in the market remains constant, but the amount of money available to purchase those apples increases. Naturally, the price of apples will rise because more dollars are vying for the same amount of fruit. This fundamental economic principle underpins the broader inflationary trends we've witnessed over the past decades. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
And the money supply has been expanding somewhere about 7.1% since 1971. And that in and of itself is the essence of the underpinnings of inflation, because more dollars chasing for goods and services that are not expanding at the same or faster rate than that money supply growth. And so basically, if you have the same number of apples with more dollars and the same, the demand for those apples is going to grow in dollar terms because there's more dollars chasing them. So it's simple. But the debt spiral, that problem really has to do with our government spending. People get all over the Treasury about how much debt there is and how the Treasury is putting us in a terrible position. But the reality is it's really Congress. It's the legislatures who are deciding how much we spend each year. And right now, if you look at everything right now, our GDP is just under $29 trillion, which means that's the gross domestic product. That's what we, as all of the citizens of the United States and the companies, are generating in dollar terms and productivity. And then tax revenues come off of that. And our tax revenues right now, according to the CBO, which is the Congressional Budget Office, and they every year put out the budget and show exactly what they're projecting, what they expect to make each year, and in total revenues and total spending and what their budget is around that. And they put this out every year. And so the latest one was updated, and in 2024, we expect total tax revenues this year to be $4.9 trillion. The problem is, Brandon, that our spending is $6.9 trillion. So that right there, it's just we're taking in 4.9 trillion and we're spending 6.9. So we have a $2 trillion deficit, which means that every single year that it stays at that level, we're adding $2 trillion to our debt. And you can go back and look at it, and our debt has been growing by multiple trillions of dollars over the last number of years. But the reality is that the big issue around this is that now, why is it a debt spiral? Well, we could just cut $2 trillion of spending, right? I mean, that would make us in balance, and we could get back to the years of so-called imbalance with Clinton, and we would be, we would not be adding to debt. But the issue here is that if you looked at the U.S. government and you considered it to be a company on the New York Stock Exchange, they would call it a zombie company. And what do I mean by that? I mean that a zombie company is operating even though it cannot pay, it doesn't make enough money to pay off its interest on past debt, so it has to borrow more just to pay that interest. Well, why is that? Okay, well, we just said the expected revenues, tax revenues, are $4.9 trillion. The spending is $6.9 trillion. If you break it down, our spending is mandatory spending. These are all the programs that are signed into legislation that they have to be paid for. This is legally, they must be paid for. Things like Social Security, Medicare, Medicaid, and other programs. But that's about $4.1 trillion. Our defense budget is $950 billion. Okay, so right there, that's over $5 trillion. We're already over budget. So right there, we're over budget. But we also so the defense, it's not signed into legislation and mandatory, but it might as well be, because these are long-term contracts with huge defense companies, and we're not going to stop spending on defense. That's just not the American way, right? So, but the third really big line item that comes in is the interest on our debt. And we spend over $1.1 trillion of interest on our debt each year. We get some of it back. The Treasury gets some of it back because it's intra-government debt. So, but the net is about $900 billion. So our total mandatory line items are $6 trillion. So, and then you've got another $900 billion on top of it. So where are we going to cut? Like, where are we going to cut enough to fix that? We're not. So what we're going to do is we're just going to issue more debt, borrow more money, use that debt that we just issued to pay off past debt that's maturing, and borrow to pay off more programs that we, just to enable all that spending. And that's what's happening every single year. And that's why our deficit is not shrinking and our debt is just growing and growing and growing. It's going to continue like this until something changes. And that is something that is that would be something catastrophic. And so we can talk through that. But right now, that's where the situation is, and there's no stopping it. So, people ask, Brandon, like, okay, so what's the solution? That's great. You have a problem. So what's the solution? What do you propose? Well, you've got three basic solutions.
Lavish outlines three potential solutions to the debt crisis, though he acknowledges that each comes with its own set of challenges. The first solution is austerity, which would involve cutting government spending significantly. Lavish points to the example of Greece during the financial crisis, where the European Union forced the country into austerity measures. However, in the US, the political reality makes this option nearly impossible. Cutting spending on programs like Social Security or Medicare would be political suicide, and no politician would support such measures. You
could have austerity, which we saw back in the great financial crisis. Greece was forced into austerity by the EU, the ECB, and the EU by saying you have to cut programs, you have to cut spending, you're gonna start being responsible. Okay, so we could cut programs. You just heard what the programs are, and so where would that money come out of? Well, it would obviously have to come out of the entitlement program. There's nowhere else to cut. So you can't you're not going to cut your defense spending in half, and you're not going to cut your interest on your debt because you're not going to default, right? So the only spot is Social Security, Medicare, Medicaid. That's insanely that would be political suicide. So, remember that politicians are the ones who are making these decisions, who are signing this legislation, who are coming up with the budget, and they want to get reelected. So that no politician would ever vote for that. So that's just kind of off the table. It's not going to happen. They'll just borrow more money and put it on the tab, which is the $218 trillion of unfunded liabilities you talked about. So that's one thing. So the second thing they do is raise taxes. So if you've ever seen, and there's a lot of debate about this, but you've ever seen the Laffer curve where you can at some point you maximize the amount of revenue you're going to get from taxes. Well, so you look over time and you look back, taxes are not, what happens is you raise taxes and you wind up lowering productivity. So companies who have, they use the money that they're earning to reinvest in profitable business lines, to reinvest in research and development, to create new business lines, hiring people, expanding, growing their footprint, and it grows that productivity. It grows your GDP. But if you raise taxes and it cuts their productivity, it closes their margins. What do they have to do? They're gonna get rid of or close down product lines that are not profitable enough or are now losing money on. They're going to start letting people go and firing people, and your productivity goes down. So what you wind up having is higher taxes on lower productivity. You either get to the same spot or worse, because now you've got declining productivity. So that's not a really good answer. Okay, so austerity, no. Higher taxes, no. So what's the third thing you can do? Well, the third thing you can do is just borrow more. Just take out another credit card and borrow more, which is what we're doing every single day. But that necessitates one more thing, and that's working with the Fed, which they're not explicitly working together on this, but implicitly they are, because what the Fed is charged with is maintaining a constant growth of money supply and inflation. And so they have two mandates, which are stable prices and full employment. And so those stable prices, the definition of that is constant 2% inflation. Well, why do they have that? Because basically what we said before is, Brandon, the US, they issue debt in their own currency. And any country who does that is not going to default on their own debt. Instead, they'll just print money and buy that debt themselves to keep the charade going, expand the money supply, right? So what they're doing is they're not going to hard default like that. They're going to soft default every single day. And soft default is inflation. That just means that they're debasing that currency, and the money supply is growing, so that when you borrow money, right? So say you're lending money to the US government, you're lending that money to them, they're going to give you that money back later, in years later, with dollars that are worth far less than you lent them when you bought that bond in the first place. So what they're doing is they're basically inflating GDP nominally, that productivity number we said, just in dollar terms, with dollars that are worth less. So when they go and tax those dollars, they pay down debt from before, past debt, that with dollars that are worth less. So it's a trick, and they've been doing it all along, and they're going to continue doing it. And so what is the solution? The solution is high perpetual inflation. It's constant, it's relentless, and it will not stop. The only question is, how high does that inflation get? And that remains to be seen.
Lavish warns that this approach leads to what he calls a soft default through inflation. Instead of defaulting on its debt outright, the U.S. government devalues the dollar through inflation, making it easier to repay its debts with money that is worth less than when it was originally borrowed. This stealthy form of default is a trick the government has been using for decades, and it's likely to continue unless a more sustainable solution is found. Lavish concludes by stating that the most probable outcome of this situation is perpetual, high inflation. The government will continue to inflate the money supply, devaluing the currency over time. While this may stave off a hard default, it comes at the cost of eroding the purchasing power of everyday Americans and creating long-term economic instability. Please like and subscribe my channel.